Good evening. Hello. Whatever James Brown or Christina Aguilera say, it's not a man's world in my house anymore. Here we go. Welcome you all to the Conference on Finance and Society. It perhaps seemed awkward that I started with a song called It's a Man's World, given the cast of characters. But I would remind you that while in 1966, when James Brown wrote that song, his intent was to talk about, in a man's world, how you needed a woman's support. But Christina Aguilera turned the tables on that song in her beautiful Grammy performance in 2007, where she was lamenting that it was a man's world and said that in that man's world, we've got nothing. We're lost in the wilderness. We're lost in the bitterness. In what context does that remind you of? Finance and society. Finance, I think is pretty clear after 2008, was lost in the wilderness. May still be in some lives. And society is certainly struggling with the bitterness of bailouts and bonuses and mortgages that push people underwater and they couldn't get out from. And it's suffering from financial executives who feel like they're continuously on trial because there was no verdict in 2008. But we can't worry too much because the old boys club was not a committee that saved the world. And at INET, if the truth be told, while the events of 2008 unmasked problems of environment and inequality and just the humility that's been missing in economics and finance, we were formed in response to the unmasking that happened in the financial crisis. The very core of the capitalist system failed at that time, and in the repair, the polluters did not pay. And it produced a horrific episode that spawned things like a Tea Party or the Occupy Wall Street movement. And it produced a climate where regulators today feel compelled to keep their distance from the financial markets for fear of being called captured. So, at INET, we're always trying to look for the way forward. It's not enough to be diagnosing the maladies. We look for a way forward. We look for examples of ideas and we look for people and to help society get back on a sustainable and a productive path and to heal the wounds of that calamitous episode. So I want to describe to you a little bit the tour that I've been on since the beginning of INET, around which time I was working with Joe Stiglitz in the UN Commission on Financial Reform, and at the Roosevelt Institute, where people like Lynn Paramore and Erica Payne injected a passion into financial reform, which is always thought to be a very technical enterprise. And then there was a woman who, if you said to me, I'm very excited with all of you being here tonight, but there's something that really hurts me tonight. And that is that because of an emergency that a friend of hers had, that Arianna Huffington could not be with us. She was supposed to be the introducer of our keynote speaker for reasons that I'll describe in a moment. Arianna is a tremendous example, a pioneer in media. She herself is an economist, and she took great interest in the consequences for society of the financial crisis. Arianna, my wife Alexis, who's sitting here in the front, and filmmaker Eugene Jarecki and I founded something called Move Your Money, based on our frustration at a holiday dinner in 2009. But when I think about this conference and why Arianna is so important, I'm reminded of an event that she held in 2010 in the spring, just after the House had passed a Dodd-Frank bill. And she asked me in the panel if I was disappointed in that bill. She knew the answer. I was very disappointed. And she said, if you could wave a magic wand and do one thing to make the financial system better, what would you do? And I blurted out, only women get to regulate finance. Just like you, the audience clapped a little bit. So I took the bait and I said, Brooks Lee Bourne, Sheila Bair, Janet Yellen, Elizabeth Warren, if they'd been running the place since 1990, we wouldn't have had a crisis. Now, I was a little bit bold, and as you know, I could find some outstanding people with Y chromosomes that have been involved in financial regulation, and a couple of double X's that I wouldn't want to look at except cross-eyed. But when I got off that stage, an elderly woman came up and grabbed my arm, and she said to me, Mr. Johnson, why is it only the women that have guts? Well, I moved forward with my colleagues at INET, and as the tale continues, I ran into another financial thinker with guts. This time it was an academic from Stanford University. Anand Admati was kind of taking on Jamie Dimon and the whole world at the same time in a way that was, in my way of looking at it, quite refreshing. And as I traveled around the world, I met people like Gudrun from Iceland and Signe from the Swiss National Bank, and I think formerly of Denmark, and Jayla from the IMF when we met at the World Economic Forum. And I started feeling like I was discovering the people that I had to find. And meanwhile, you know, clock's rolling along and things happen, like Christine Lagarde becomes the head of the IMF, the managing director, and Janet Yellen is promoted to be the Fed chairman. And while that's taking place, my wife became the chairman of the board of Planned Parenthood Federation of America. We had two girls, Sage and Dylan, who you met briefly. The conversation in my home, the gatherings and the debates were like never before. And she helped me, Alexis helped me to see, and the examples that I've mentioned to you helped me to see, that the way forward was hiding in plain sight. It happened to be that they were women. And these women are leading us toward an understanding and renewed representation in the healing of this dreadful wound of a financial crisis. And while there are many ways that INET's also committed to investigating the politics and economics of how we do not serve women as members of society and how humankind could do much better, that's not the focus of tonight. Tonight and tomorrow, this conference is an experience of excellence. This conference is a celebration of demonstrated excellence. And the excellent women who stand at the intersection of this enormous challenge, which I think the tension between our financial system and our society is critical to everything. The legitimacy and the credibility of our society depends upon healing that wound. People don't trust in ways that they should trust in order to cooperate, and they use that malfunction, that dysfunction, as a way of, which you might call, pulling out of the courage that it takes to cooperate. I must confess that it's good for my daughters to get a taste of that excellence. Role models are good for everyone. But even more powerful for them to see, and for my son to see, and for all of our sons and daughters to see, is that led by these people, these leaders who happen to be women, there is hope to repair and rebuild our society and its legitimacy and our faith in the future. That, in the depths of my heart, is what I celebrate at this conference. It is said that when Picasso painted Guernica, the people already knew that Spain was at war. But when Picasso painted Guernica, the world began to see and feel that there was a terrible war in Spain. When an artist like Joni Mitchell, whose famous song, The Woman of Heart and Mind, sings her revealing in her personal songs, we feel those feelings of our lives come to life, and we experience ourselves more powerfully and more vividly than ever before. And when it comes to the contentious intersection between finance and society, there is one person who stands out in my mind as the artist at the vanguard of this challenge. At this time, at this place, here and now, through her work that's been first as a devoted academic to understand the experience of bankruptcy, through her service to financial oversight of controversial bailouts using public money, through her contribution to financial reform legislation, and most prominently now through her role as an elected official, where she uses her skill and her will to raise the power and the intensity of the debate. She is that symbol, that beacon. She is that artist who, for me, is our most inspiring and courageous storyteller on these questions of the healing of finance and society. Please join me in giving a warm welcome to Senator Elizabeth Warren.
Thank you. Thank you. Oh, thank you. Thank you. No, thank you. Thank you. Thank you. Much too generous. Thank you. Thank you. Thank you very much for the very kind introduction, Rob. And thank you for being here tonight, girls. And thank all of you for being here tonight. You know, this is really an amazing conference, and it is a great pleasure to be with all of you, and also a great honor to be able to start the conference this evening. You know, I believe in the questions that this conference will address, like what role finance should play in society, and how it is that we design and enforce laws to achieve the results that we need. And since I'm lucky enough to get the opening position here tonight, I want to start with a framework to think about these ideas and hope that it may be part of the conversation on through tomorrow. For me, this frame starts with the Wall Street crash of 1929. You know, up until then, the consensus was that financial booms and busts just happen, and there is nothing to do about it. You just take what comes. But in the 1930s, policymakers stepped up. They changed the laws to make sure that excessive speculation and risk-taking on Wall Street couldn't push our economy over a cliff. They believed they could make change. The new rules that they put in place were creative and unprecedented. First, a cop for Wall Street, just like cops for Main Street. Yeah. The new agency, the SEC, was charged with enforcing basic rules of the market. Second, make it safe to put money in banks. Yep, always. FDIC insurance created security for families and stability for the banking system. And third, banking should be boring. Glass-Steagall built a wall so that banks couldn't use government-guaranteed deposits for high-risk speculation. And here's the amazing thing. For half a century, those new rules worked. There wasn't a serious financial crisis, and the financial sector did its part to help produce sustained, broad-based economic growth that benefited millions of people around this country. And then, in the 1980s, a new political wind swept across the country. They called it deregulation. But what it really meant was get rid of the cops on Wall Street. The Fed and other bank regulators just looked the other way as big financial institutions invented new ways to trick their customers, first through credit cards and then ultimately through mortgages, home equity lines of credit, and a whole host of other financial products. The wall between the high-risk trading and boring banking was knocked down, and Glass-Steagall was eventually repealed. Washington turned a blind eye as risks were packaged and repackaged, magnified, and then sold to unsuspecting pension funds, municipal governments, and many others. Now, not long after the cops were blindfolded and the big banks were turned loose, the worst crash since the 1930s hit the American economy, a crash that the Dallas Fed estimates has cost this country a collective $14 trillion. So the way I see it is that the moral of this story is simple. Without basic government regulation, financial markets don't work, period. That's just an empirical fact, clearly observable in 1929 and clearly observable again in 2008. It's a point worth repeating because for too long, the conventional wisdom has been you can be for rules or you can be for markets, but you can't be for both. That is not a choice. Rules are not the enemy of markets. Rules are a necessary ingredient for healthy markets, for markets that create competition and innovation. And rolling back the rules or firing the cops can be profoundly anti-market. We need rules. Now, I don't kid myself. Not all rules promote innovative and competitive markets. So a big part of what we have to talk about is what the tests are that we should use to make sure that the rules promote healthy competition and innovation. So I just wanted to say, I think we start with two principles that work pretty well for more than 50 years after the 1929 crash. First, financial institutions shouldn't be allowed to cheat people. Could I have an amen on that? You know, it really, you say it and people laugh, but it's the truth. Markets work only if people can see and understand the products they're buying, only if people can reasonably compare one product to another, only if people can't get fooled into taking on far more risk than they realize just so that some corporation can turn a quick profit and move on. That's true for families buying mortgages, and it's true for pension plans buying complex financial instruments. No cheating. Second, financial institutions shouldn't be allowed to get the taxpayers to pick up their risks. Anat, that's for you. That's right. That's true for using insured deposits for high-risk trading and the reason that we had Glass-Steagall, and it's true for letting too big to fail banks get a wink and a nod guarantee of a government bailout. Now, the departure from these two principles in the 1980s and 90s paved the way for the 2008 crisis. Our best hope for stopping the next crisis and for creating financial markets that are safe and competitive and innovative is to return to these basic principles. No cheating people and no pushing your risks off onto the taxpayer. So, judged against these two principles, Dodd-Frank made some real progress, but there is more work to be done. Look at the first goal, no more cheating people. Dodd-Frank took a powerful step toward honest markets with the establishment of the Consumer Financial Protection Bureau. It just really did. You know, instead of this grab bag of consumer protection laws that were scattered among 7 different agencies, none of whom had any real interest in enforcing them, Congress created a single new agency that had the tools, it had the expertise, and it had the responsibility for making sure that consumer financial markets worked fairly. That was real change, it was structural change, and it's working. Mortgages have gotten clearer and easier to read. In just 4 years, that little agency has already forced financial services companies to return more than $5 billion directly to consumers they cheated. That is government that works for the people. Yes. But cheating still happens, and we need to fix that. Right now, the auto loan market looks increasingly like the pre-crisis housing market. There's rampant subprime lending, predatory and discriminatory lending practices, and increasing repossessions. And while the CFPB has oversight for mortgages and for credit cards and for checking accounts, it doesn't have complete oversight of the auto loan market because Dodd-Frank specifically carved out the auto dealers. We need to fix that by giving the consumer agency the power to supervise the market for auto loans. That's what we need to do. And second, it is time for the Justice Department and the SEC to get serious about enforcing our laws against financial fraud. These agencies don't take big financial institutions to trial ever, even when financial institutions engage in blatantly criminal activity. Instead, they use what they call deferred prosecution agreements or non-prosecution agreements, in which they ask the offending firm, pretty please, to pay a fine and work with the government to come up with a plan for doing better in the future. These kinds of agreements were originally created to deal with low-level, nonviolent individual offenders, and they have now been transformed beyond all recognition to create a get-out-of-jail-free card for the biggest corporations in the world. It is time to stop financial recidivism in financial crimes and to end this slap-on-the-wrist culture that exists at the Justice Department and the SEC. So let's just say it. No firm should be allowed to enter into a deferred prosecution or non-prosecution agreement if it is already operating under such an agreement. Period. No. Any firm that enters into one of these agreements should have to pay as a mandatory minimum fines that are at least equal to every dime of profit generated from their illegal activity. And third, this is about structural change. We should change the legal standards so there's some meaningful judicial review of whether these agreements are adequate. Those steps can cut down on the cheating in our financial markets. So what about the second goal? Making sure that financial institutions can't push their risks off onto the taxpayers, that no institution is too big to fail. Now again, Dodd-Frank changed the landscape. It helped bring back some level of market discipline through living wills and through the creation of orderly liquidation authority. And it reduced system-wide risk by imposing a more demanding capital standard and more demanding leverage standards. And those are important steps and well worth defending. But let's get real. Dodd-Frank did not end too big to fail. Last summer, both the Fed and the FDIC reported publicly that 11 of the biggest banks were still so risky that if any one of them started to fail, they would need a government bailout or they would risk taking down the American economy again. That is a statistic that should keep everyone awake tonight. So what should we do about too big to fail? Answer, end it once and for all. Not talk about ending it, end it, truly end it. So how? First, break up the biggest banks. Just break them up. Cap the size of the biggest financial institutions, adopt a 21st Century Glass-Steagall Act that rebuilds the wall between commercial banking and investment banking. If banks want access to government-provided deposit insurance, they should be limited to boring banking. Yeah. If banks want to engage in high-risk trading, they can go for it. They just can't get access to insured deposits and put the taxpayer on the hook for some of that risk. I just think it's that simple. Yes. Second, carefully limit the Fed's ability to provide emergency lending to a giant bank that gets into trouble. In the 2008 crisis, the Fed used its emergency lending authority to provide, I'm glad everybody's sitting down, $13 trillion in low-cost loans to a handful of too-big-to-fail banks. Think about that. It wasn't TARP or anything that Congress voted on. On their own, the Fed just kept shoveling money at nearly zero interest rates into a half dozen too-big-to-fail banks. Congress should step in and make clear that the Fed is not the personal piggy bank for the biggest financial institutions in this country. So, hold cheaters accountable, cut giant banks down to size, good steps. But they can only do so much when they are at odds with basic tax laws that encourage the very kinds of excessive risk-taking that we need to eliminate. Reforming our tax laws is also part of the unfinished business of financial reform. I want to give you 3 quick examples on this. First, executive compensation. Dodd-Frank recognized that executive pay should be aligned with the long-term interests and the stability of the corporation and ultimately the economy. But our tax code pushes in exactly the opposite direction by taxing compensation over $1 million unless it's in the form of performance-based bonuses. That carve-out has caused bonuses to shoot through the roof, bonuses that too often reward short-term risk-taking. We can close that loophole and stop pushing companies to reward short-term thinking at the expense of long-term performance. That's the first one. Second one, debt bias. After the crisis, there was near universal agreement that big banks needed more capital and less leverage. But again, the tax code pushes in the exact opposite direction. The tax code has a massive bias in favor of debt financing over equity financing because interest is deductible but dividend payments aren't. It's time to change these rules so that the amount of interest a firm can deduct annually is based on the relative amount of capital that the firm holds. And third, volatility. High-frequency traders introduce more instability into our financial markets through arbitraging gimmicks that add no value to the economy. We can institute a targeted financial transactions tax that would have no impact on regular mom-and-pop investors, but that would push sophisticated trading firms to invest in companies for the long haul and strengthen our markets. The principles I've identified, the proposals I've made, should appeal to both Democrats and Republicans. Everyone, regardless of their party affiliation, should want simple structural rules that produce safer and more competitive financial markets. And I'll say, there are a few hopeful signs. Last year, I introduced a bill that would rebuild the wall between commercial and investment banking, the 21st Century Glass-Steagall Act, with a bipartisan group, including Republican Senator John McCain, Independent Angus King, and Democrat Maria Cantwell. Last week, I introduced a bill that would make federal agencies more accountable for their agreements. It's called the Truth in Settlements Act, with Republican Senator James Lankford. These bills aren't the law yet, but they demonstrate that it's possible, just possible, to make progress to complete the unfinished business of financial reform. Of course, the big banks are fighting tooth and nail against these changes, and we saw them flex their power just last December when they blew a hole in Dodd-Frank as part of the omnibus. Now, The way I see this, when I watch them do this, is we had two choices. We can give up or we can fight back. Me, I think we should fight back. I am fighting back on this. But before concluding, I want to touch on one more thing that I consider as an overlooked threat to the safety of our financial markets, trade policy. As long as we're talking frame, I want to make sure trade policy gets in here as well. In the next few weeks, Congress will decide whether to give the president fast-track authority. That authority would prevent Congress from amending trade deals and would reduce Congress's ability to block trade deals, not just for the upcoming Trans-Pacific trade deal, but for any trade deal cut by any president over the next 6 years. Think about that for a moment. Look, I very much hope that a Democrat wins the White House in 2016 and again in 2020. But what happens if we have a Republican president in 2016 or 2020? Just think about this. Ted Cruz has already stated flatly, we need to repeal Dodd-Frank. That is a direct quote. No mushing around the edges here. We need to repeal Dodd-Frank. And other Republican contenders have already joined in. Republicans have been itching to tear down Dodd-Frank from the moment that it passed. Now, this is a long-term problem, a 6-year problem if fast track passes. A Republican president could easily use a future trade deal to override our domestic financial rules. And this is hardly a hypothetical possibility. We are already deep into negotiations with the European Union on a trade agreement, and big banks on both sides of the Atlantic are gearing up to use that agreement to water down financial regulations. A 6-year fast-track bill is the missing link that they need to make that happen. So let me put this as simply as I can. After fighting hard to protect Dodd-Frank for years, Democrats in the next few weeks could give Republicans the very tool they need to dismantle Dodd-Frank. Anyone who supports Dodd-Frank and who believes we need strong rules, stronger rules, to prevent the next financial crisis should be very worried. The quest for safer and more competitive markets is an economic fight. But make no mistake, it is also a political fight. When Teddy Roosevelt broke up the monopolies, he was focused not so much on our economy as on our democracy. Big corporations, Roosevelt said, should not have the power to interfere in politics in order to secure privileges to which they are not entitled. Our economy suffers when those who can hire armies of lobbyists and make huge political contributions can decide what the financial cops can and cannot do. Our democracy suffers when Congress puts the interests of a handful of giant banks ahead of the needs of 320 million American citizens. If the big banks keep calling the shots, they will own both our economy and our democracy. We know what changes we need to make so that financial markets don't just work for powerful insiders, but so that they work for everyone. Strengthen the rules to prevent cheating. Make the cops do their jobs. Cut the banks down to size. Change the tax code. Don't adopt trade rules that open the door for financial deregulation. The key steps aren't hard. They just take a little political courage. Thank you all for being here tonight. Thank you. Thank you.